Tax set. How hard is it for the 50th time?
But it's Labor's broken promises on property taxes that could come back to bite.
The core of this budget is an economic strategy.
Eventually, the tenant picks up the tab.
There's no doubt the 2026 federal budget has stirred things up for investors, business owners, and everyday Australians trying to get ahead. But is it really as bad as everyone is saying? And what does it actually mean for your personal situation? But here's the thing. Knowing what was announced is the easy part. Almost every news outlet in the country has covered the headlines by now. The harder question, and the one almost no one is actually answering, is what these changes mean for you specifically. Whether you're holding investment properties, running a business, or just trying to grow your income without ATO eating half of it. Because adapting is what gets you the outcome you actually want. Complaining just keeps you stuck exactly where you are. So I've gone through the full budget papers, the explanatory memos, and everything you need to know about this announcement, and I've broken it down into a video that covers 3 parts. The changes that have actually been confirmed and are coming into effect, how each of them hits investors, business owners, and everyday Australians differently, and what you can practically do right now to position yourself on the right side of these changes before they roll out. With that said, let's get into it. Let's start with the headline. The 50% capital gains tax discount has been removed and replaced with an inflation-based system with a minimum 30%, effective July 2027. This is the single biggest change to how Australians are taxed on investment property since Peter Costello launched the discount in 1999. Before 1999, you had to adjust your cost base for inflation every year you held an asset. The 50% discount simplified everything and turned property into the most tax-effective wealth-building vehicle in the country. The shock with the policy is that it reaches well beyond residential property. It was designed to impact all asset classes: property, shares, business, equity, the lot. That's a 27-year reset on how Australians build long-term wealth down in one budget night. And here's who actually wears it. The ultra-wealthy aren't meaningfully affected. Their wealth sits across commercial, private equity, global equities, offshore allocations. A change to the Australian CGT discount is a footnote in their quarterly meeting. The people who actually feel this are the ones in the middle. Hardworking Australians trying to climb, and in particular younger people trying to accumulate wealth, because anything they do, buying and selling, investing in shares to grow a deposit, now gets whacked at a higher rate. The ladder just got steeper for the exact people who needed it the most. So here's what you actually need to think about between now and July 2027. If you're holding an investment property you are already planning to sell in the next few years, the question becomes whether you bring forward that sale. The 50% discount is locked in until July 2027. After that, your effective discount drops to a minimum of 30% and moves with inflation. For a property you've held for a long time with significant gains, that gap is meaningful. Run the numbers with your accountant on selling pre-July 2027 versus your original timeline. If you're holding a property you intend to keep long term, selling to lock in the old rules usually doesn't stack up once you factor in agent fees, stamp duty, and if you re-enter, and the loss of grandfathered negative gearing benefit, which I'll cover in the next section. The CGT change doesn't override good portfolio strategy. Don't let a tax change push you into a transaction that you wouldn't otherwise make. If you're an existing investor planning to hold past July 2027, you'll need to reevaluate your properties at that date to establish a new cost base. Speak to your accountant about getting formal valuations done close to the cutoff, because that valuation becomes the reference point for every future CGT calculation for those assets. And if you haven't bought yet, but you're planning to, the CGT change is now a permanent feature of the landscape. It doesn't kill the case for property, but it does mean the holding period and the entry price matter more than they used to, because you've got less margin for error on the back end. This is why I'd argue these changes are revenue grabs dressed up as housing affordability policy. The wealthy have room to adapt, the middle class picks up the bill. The second major change is negative gearing. Effective 7:30 p.m. on the 12th of May 2026, negative gearing on existing residential property is being wound back. If you buy an investment property after that cutoff, you can no longer deduct your rental losses against your salary income. You can still deduct them, but only against other residential property income like rent or capital gains. Any unused losses carry forward to future years. The only exception is brand new builds. Buying a new building after the cutoff and full negative gearing against your salary still applies. This is the government's way of pushing investor money towards new supply rather than bidding up existing stock. This is the end of an era. The strategy of building a 6, 8 or 10 property leveraged residential portfolio of existing homes with the tax office quietly subsidising your holding costs against your day job income is now structurally dead for anyone starting from scratch. That's a 25-year-old playbook being shut down in a single budget night. The critical detail everyone's asking is whether existing portfolios are grandfathered. And the answer might actually surprise you. Yes, fully. Every investment property purchased before the 7:30 p.m. cutoff date on the 12th of May keeps its full negative gearing benefits, the deductibility against salary for as long as you hold it. Doesn't matter if you sell in 2030 or 2045, the old rules ride with your property until the day that it leaves your name. Now here's what very few outside the broking world are talking about just yet: the serviceability impact. When a lender assesses your borrowing capacity on an investment property, they factor in the negative gearing benefit as part of your cash flow position. If that benefit gets removed, as it has been, then we are looking at a scenario where that negative gearing benefit becomes removed and we could have a significant adverse impact on your borrowing capacity. An example, previously a client who had an existing owner-occupier was looking to purchase a $1.2 million investment property, fully funded with equity and debt. This was feasible prior to the change with negative gearing. Now, with these lender servicing calculators, if they change, the add back is removed, then borrowing capacity will drop by $385,000, which is a substantial change. Now there is a loophole here for negative gearing. Technically, investors can still go out and buy that property before July 2027 and still negatively gear it. However, unless that property was bought before the cutoff on the 12th of May, the negative gearing will cease in July 2027 on that property. Complicated, right? Potentially, this could be the government leaving the door open to reversing this policy decision. But what it does mean is that if you wanted to buy something now, technically it services today and it won't service tomorrow. So there is a window. But here's the thing, this doesn't just affect your next purchase. It affects your refinancing capacity on properties you already own. If a lender reruns your serviceability under the new rules and you no longer meet their criteria, you can end up stuck on your current rate with no ability to refinance. What this means in practice is that the investors who win are the ones with the most efficient portfolio. The ones that hold 3 well-positioned cash flow positive assets are now in a structurally better position than the ones holding 8 negatively geared properties whilst betting on the long-term effects of negative gearing. It also opens up a discussion as to the suitability of different structures, and particularly a company structure, which is something we'll discuss further in future. If you're an existing investor with investment properties, well, congratulations, you've scraped through with all your negative gearing benefits. Realistically, this incentive for you to sell those properties has been greatly diminished. If you're an investor who hasn't bought a property, then I'm sad to say that you don't get the red carpet of the previous scheme. However, you can still benefit from the carry forward of operating losses against that property in future years. So the end result is realistically not that bad. No matter where you are on the ladder, it's important to make a plan. More on this later. Now the last change they've made is about Super and Division 296. Now this didn't come through the budget, but it passed in March 2026. As a result, it starts on the 1st of July 2026, just weeks after the budget. If your total super balance is above $3 million, your earnings on the portion above that threshold will get taxed at 30% instead of 15%. And above $10 million, that rate jumps to 40%. Yes, this only directly affects around 90,000 Australians today, but that's not the point. If you're a disciplined saver who's been maxing out super contributions for the last 15 years, you'll cross that $3 million line sooner than you think. The good news, the original version of the proposal taxed unrealized gains, meaning that you'll pay tax on paper profits before you've actually banked anything. That was scrapped in October 2025. Only realized earnings are taxed now, and both thresholds are indexed to inflation. Now, with the changes to negative gearing and CGT, self-managed super fund has become even more attractive. However, this Division 296 rule puts a real dent on the capacity to scale things within this superannuation environment. Here's what you can do about it. Now that we know what the changes are, how they affect each type of investor, and why they don't actually fix housing affordability, the focus shifts on what you can do about it. Because at the end of the day, that's the only thing that you can control. The single most important thing to understand when it comes to lending is that despite these changes, the same fundamentals apply today. However, there may be a point where borrowing capacity shifts based on what happens with negative gearing. If they remove the interest add back, borrowing capacity drops substantially. To give you an example, I've got one client who can currently purchase a $1.2 million purchase fully funded. Under the new rules, that drops by almost $400,000. That said, because you'll be able to carry forward losses to future profits with each property, you could hypothesize they could potentially leave this calculation in. Either way, the practical takeaway is the same. There is a window right now where you can still borrow with negative gearing, even if it gets discontinued beyond July 2027. The biggest mistake you can make at this point is giving up on investing altogether. Just because conditions aren't as favorable as yesterday, that doesn't mean that it's not worth doing. Have a look at history and think long term. Markets have a way of balancing out, because ultimately supply and demand is king. And if you're already sitting with 3+ properties, you've still got negative gearing, so you're in good shape. The main question mark there becomes what your exit looks like and how you manage these different CGT rules. Now, in terms of structure, it's well worth discussing with your broker and accountant what it looks like buying in a company structure rather than your personal name, particularly if you're self-employed. There's potentially a strategy you could build out there. For me personally, I'm honestly undecided on next steps. I've got existing investment properties and these changes have basically removed all incentive for me to sell down. If I do want to buy more property, that'll most likely be in a company structure, and I'll look to use debt via equity in my personal name to invest in equities, where there's still a negative gearing benefit. If you're looking for a team of brokers who are investors themselves, understand the lending market, and can tell you what you can actually do about your own unique situation, then click the link below and let's have a chat. And with that said, thank you guys so much for watching. I hope you got value from this video. Please subscribe if you haven't already. And if you have any questions, leave them in the comments and I will get back to you.